Markets leave ASX lower as mining losses offset banks soared post by newest toldest 4:35 p.m. on the 6th of December 2017. That's it for Markets Live for today. Thanks for reading and for your comments. See you all again tomorrow morning from 9:34 p.m. on the 6th of December 2017. The ASX stumbled on Wednesday, with miners selling off after a plunge in their copper price depressed sentiment around the sector. The index declined 25 points, or 0.4%, to end the session at 5,946. The broader All Ordinaries lost 26 points, or 0.4%, to end the session at 6,030. The traded at $75.79 after falling sharply following a slightly softer than expected GDP print for the third quarter of 0.6%, with the annual rate also coming in slightly below economist expectations at 2.8%. Tying with their recent business strength together with the equity market, Citus Australian equity strategist Tony Brennan noted that have been reported as being considerably above average. All of which should mean, Mr. Brennan said, while forecasting the benchmark ASX 200 measure will end 2018 at 6,400 points. Across sectors, the largest improvement has been in mining, but construction and manufacturing have both also picked up, and in fact all sectors have been reporting conditions above average. Apart from retailing, miners had a bad day on Wednesday, weighing the index down after a spectacular drop in copper prices in London overnight. Majors trading lower included, which was lower by 2%, down 2.5%, down 4.1% and down 1.6%. Smaller companies that saw their share prices pounded included, down 5.4%, and down 5.3%. Most banks managed a bit of a bounce from, but they have kept the sector under pressure since last Thursday. Rose 0.7%, climbed 0.5% and rose 0.3%, was down 0.2%. Sentiments award, the banks and the political uncertainty seem to have been factors holding the market back, noted Mr. Brennan. Shares ended the day up 1.3% after the telecom reiterated 2018 financial guidance given in September, although shareholders gave the telecommunications provider its first strike over executive pay. Jumped 6% to 44 cents after a Mexican fund manager based in Guadalajara spent almost $250,000 buying extra shares in the ailing vacuum cleaner retailer in late November just before its profit downgrade. 4:16 p.m. on the 6th of December 2017. LNG players breathing a sigh of relief that in 2017 were off the mark may only have had a temporary reprieve, while this year has held threatened oversupply at bay. Some believe a 5-year bout of market weakness is still to come. In a global LNG report released by Macquarie, the bank predicts, or even as long as 2027 if advanced projects in the pipeline are taken into account. The rise of renewables and outperformance by plants could push that out even further. That sets the scene for bleak outcomes from LNG pricing reviews for supply contracts over the next few years, Macquarie said, with one of the players singled out as having the most exposure on that front prior to 2020. Woodside has its sales contracts for its Pluto LNG venture up for review, with Macquarie envisaging with customers Tokyo Gas and Kansai Electric. Amid sustained oversupply of the global LNG market, Pluto will be among 43 million tonnes of volume under legacy contracts up for repricing before 2020, the bank said, confirming its call on the stock. Additionally, with the commencement of 14th of new volumes by 2019 from the US alone, we do not see Woodside having much leverage in the negotiations. While many other commentators are on the outlook, the expectation is for a flood of new LNG supply to hit the market in 201,819, taking a toll on spot prices that are now at their highest since early 2015. Peter Cleary, an independent LNG consultant and former vice president LNG at Santos, said 2018 and 2019 have, which will affect the price of the commodity. That's Economics 101. 3:49 p.m. on the 6th of December 2017. Amazon's Australian launch may have underwhelmed shoppers and eased their fears of local retailers, but it more than met the Seattle-based e-commerce giant's expectations. Amazon said on Wednesday that with tens of thousands of customers visiting the site during their first 24 hours, orders were placed across all 23 of the categories, and some of the best-selling products included deeply discounted finished dishwashing powder and tablets, mini flashlights, high-pressure hoses, Fitbit devices, men's shavers, Huggies nappies and even dust mop slippers. After a false start on Black Friday, Amazon launched its new retail offer on Tuesday morning, selling millions of products across 23 categories including toys and games, consumer electronics, sporting and outdoor goods, tools and home improvement, beauty products, household goods, clothing and accessories. With Amazon more expensive on some products such as iPhones, cables and appliances, and cheaper on others, especially groceries. Amazon's range was also narrower and not as deep as expected and was dominated by third-party or marketplace sellers. Read more here. 3:21 p.m. on the 6th of December 2017, TPG shares are trading up 1.3% this afternoon. The company said it expects underlying earnings before interest, tax, depreciation and amortization of between $800 million to $815 million. Still, shareholders fired a warning shot to the company's executive chairman, David Tao, delivering the telecommunications provider a protest vote of 29.9% of shares were voted against TPG's remuneration report. 70.1% of shares were voted for at the company's annual general meeting on Wednesday. Tao owns 34.4% of the company's shares in Washington 8. Sol Patterson, whose chairman Robert Milner sits on the TPG board and owns 1.6% on his own, accounts for 25.2% of shares. Close to 75% out shareholders, outside of Mr. Tao and Mr. Milner, voted against the remuneration report. We are disappointed in the number of votes against the remuneration report, especially when you consider the structures we've had in place have been very successful over the years, TPG Director Dennis Ledbury said. Back to top 250 p.m. on the 6th of December 2017 for the first time amid speculation that the widespread use of futures will help lead to digital currencies being viewed as a legitimate asset class for mainstream investors, Bloomberg is reporting. The largest cryptocurrency by market value has soared from less than $1,000 at the start of the year as known as blockchain that is at the heart of Bitcoin. The price surge has been accompanied by a growing chorus of warnings that the speculative frenzy is an asset bubble poised to burst. Though Global Markets has said it will start trading Bitcoin futures on December 10, while CME Group's contracts are set to debut on December 18. Nasdaq is planning to offer futures in 2018, according to a person familiar with the matter. Cantor Fitzgerald's Cantor Exchange is creating a Bitcoin derivative, and startup Ledger already offers options. 2:31 p.m. on the 6th of December 2017, Slater and Gordon shares are up 26% to 4 cents today after shareholders. Almost 70% of votes at the firm's annual general meeting in Melbourne on Wednesday backed the plan, which will see hedge funds led by New York-based Anchorage Capital assume control in a debt-for-equity deal. Chairman John Skippon said recapitalization was essential for Slater and Gordon to avoid insolvency and the only way to secure a future for the firm and its stakeholders. 2:08 p.m. on the 6th of December 2017 it was AI versus Warren Buffett. The artificial intelligence was unleashed by Winton, the London hedge fund, to test an old principle of the Berkshire Hathaway chairman. Researchers collected and analyzed data on almost 9,000 US deals back to the 1960s. The result? Winton says Buffett's thesis doesn't hold up. Big acquisitions don't inherently destroy value, said Daniel Mitchell, who runs a team of data scientists at the $30 billion hedge fund. Buffett didn't respond to a request for comment sent to an assistant. Bit by bit, after many false dawns, going back decades, giant money managers like Two Sigma and Goldman Sachs Group and smaller players like Schoenfeld Strategic Advisors have adopted it as a cornerstone strategy or a search tool. From this foothold, how far will AI go? Man Group Luke Ellis. The $103 billion firm in London already devotes about $13 billion to several hedge funds using machine learning. In 10 years, it will play a role in everything man does, From executing trades to helping pick securities at the firm's discretionary unit, Ellis, the chief executive officer, said in an interview, "If computing power and data generation keep growing at the current rate, then machine learning could be involved in 99% of investment management in 25 years, Ellis said. "It will become ubiquitous in our lives. I don't think that machine learning is the answer to everything we do. It just can make us better at a lot of things that we do." 1:44 p.m. on the 6th of December 2017. Wattle Health, to bolster the brand in its home market, which is considered crucial in building long-term success in the eyes of consumers in China, AFR's Simon Evans reports. It's due to come out of the trading halt prior to the start of trading on December 7, which operates 400-plus outlets and is owned by Australian Pharmaceutical Industries. Wattle has been seeking to expand its Australian footprint. Wattle declined to comment on Wednesday. The company's shares have been on a rollercoaster ride since listing on the ASX in mid-March this year at an issue price of 20 cents. The shares soared to $2.70 in mid-November, even though it was registering modest sales revenue, largely on the strength of future upside in China and a small stake in a Melbourne infant formula packaging facility acquired by a large Hong Kong-based consortium. But in the past few weeks it has come back with a thud to $1.55, which still makes it one of the most successful floats of 2017. It already has distribution agreements with Aid in China, Tesco Lotus in China, and Metcash and some of its IGA and Foodland outlets in Australia. It also sells in Baby Mode retail stores in Australia and Junior duty-free stores, which was its first main avenue to market. 1:08 p.m. on the 6th of December 2017. Here's scientist Tony Brennan on the prospects for the Australian equity market since its bounce in October, despite the strong global economy, slowly improving conditions domestically, and a reasonable AGM season. Admittedly, consensus FY18 has been pared by 11.5% since August reporting season, but market growth has been raised 2% overall due to resource earnings. The operating environment for companies seems to be getting better, despite varying across sectors. Even after earlier upgrades, we continue to estimate that another 5% or so. If the market moves up to our forecast of 6,400 by end next year, we see performance concentrated in the resource sector still. Other cyclical sectors, majority household facing, seem to offer less now, including banks, but the added areas we see opportunities in remain some of the other oligopolies, supermarkets and insurers, though not yet telecoms. Back to top 1,251 p.m. on the 6th of December 2017, and a few more economist thoughts about that GDP. Reading real GDP growth in Q3 17 came in slightly weaker than the consensus 0.7%, but slightly stronger than our tracker 0.4% QQSAR, at 0.6% QQSAR not annualized, from a revised 0.9% QQ in Q1 17, 0.8% preliminary. On a year basis, Q3 17 GDP growth improved significantly to 2.85%, owing partly to a low base, which continues to project an economy in an early recovery stage with ongoing reliance on trade and public spending to support activity. We continue to see growth recovering gradually, and maintain our 2018 growth forecast at 3.1%, and slightly raise 2017 to 2.3%. Aussie economic conditions have improved markedly after a weather-impacted start